'cause I'm the tax man. Yeah, I'm the tax man.
Well, if you're still in a holiday fog, I got to tell you, it's time to shake it off and start planning for tax time. Here to get us up to speed on big changes and big reminders is Mark Lloyd, who runs the money management firm, the Lloyd Group, and we want to thank you for being with us. We got a lot to get to this morning, so let's get moving. We're going to start with health care. Some folks decided it cost too much, so they blew it off. They decided to take the fine.
Yes.
You're not going to be able to do that coming up.
Considerable hike in what that fine is next year. 2% of your income. That's huge.
So you make $70,000 as a family. What does that mean?
That's $1,400 fine.
Yikes.
So let's say your income's less. If it's a family plan, it's $975. Just an individual is $350. So they have raised the fines if you do not have health care coverage. So you might want to take a second look at whether or not that makes sense.
Okay. Add your retirement savings?
Absolutely. Now here's the good news. We got a little bit of grace period here between now and April 15th. If you're under age 50, you can contribute up to $5,500 into your IRA and get an immediate tax write-off on that. Now if you do a Roth IRA, you don't get the tax write-off on the contribution, but all of that interest, which is compounding, your principal's earning interest and your interest is earning interest, is all tax-free.
If you ignore this, you're giving up free money.
Absolutely.
Okay.
Same thing with your 401k. So in your 401k, if you're under age 50, you can contribute up to $18,000. And if you're 50 or over, you can do a catch-up up to $24,000. That's huge because that's free money. That's free money that you're not paying taxes on, plus all of that growth that you can get later on down the road.
And I'm just going to say it one more time, free money. All right. So I need everybody to follow me on this one. If you've turned 70 and a half this year, and don't get hung up on that math yet.
Right.
Look at that later, because this is the math you need to know, because a mistake will cost you a lot of money. What are we talking about
At
here?
70 and a half, IRAs and 401ks, if you're already retired, require a required minimum distribution. Now that required minimum distribution is usually about 3.65%, let's say round it up to 4, of whatever your balance was. If you miss that payment or that withdrawal, 50% tax penalty. The IRS doesn't mess around with this one. They want you to take out your distributions. 50% tax penalty of what that number should. Absolutely. So we only have 2 more days. If you're already 71, 72, 73 or older and you haven't done it, you just forgot about it, you only have a couple more days to get it done.
What does 70 and a half mean?
That's just a number, that's an age that the IRS came up with publication 590 that says, look, you've been deferring all these taxes all these years, it's time to pay up.
So we're talking December last year through?
Right, so let's say you turn 70 in January of this year. Well, you're okay, your 70 and a half is this year, but let's say you turned 70 last year, you could kind of delay it till December 31st of this year.
Okay, we got a couple of reminders though too, sort of some housekeeping.
Yes.
Your FSA, your savings account.
If you don't use it, you lose it. So you got 2 more days to do it. Same thing with charitable contributions, whether it's taking something to a charity, which would be goods that you want to discard or something like that, like a Goodwill type thing. You have a couple days to get that tax write-off there, or maybe donating to your church or to a religious organization or a charity of any kind. If you are doing itemized deductions, you get a 50% write-off off of that last number on your 1040 form. That's the adjusted gross income. So if you gave a $1,000 donation, you get to take $500 off of that. Again, that's free money for you.
Okay, and then withholding. That's one more thing to just take a look at as we go into the new year. And a lot of us don't do that.
I know.
We just leave it and we walk away and we don't worry about it.
Some of my clients have opted to always take out the most out of their checks. And then they get this tax refund and they use it for vacations. But me being the financial guy thinks I'm losing interest on that money because the IRS doesn't give you any interest for them, saving that money and giving it to you later. But if you're late on your taxes, they charge you a high interest penalty.
Right.
So if you have to do that for discipline, I get it. But if you don't, look at your deductions, look at your withholding inside of your paycheck and make that more in line with what you pay in taxes so that you can take the rest of that money and invest it long term and make more money on your money.
I don't do that. I hold it, and then when I get my refund, which I always get, I do a house project.
Well,
So
that's
you got to
okay.
know
Yeah,
who you are.
I get it. It depends upon the person. That's okay.
All right. As always, thank you so much. You've been joining us all morning, and we really appreciate it.
My pleasure.
Mark Lloyd is always helping us through these financial waters. So I know April 15th seems a long ways out. We all know it's not really. So let's get started.